This program is brought to you in association with First National Bank of Botswana.
Fnbb, how can we help you?
Good evening and a very warm welcome to First Issues. Thank you so much for joining us on the program. Following far-reaching outcomes of the COVID-19 pandemic in 2020 that led to a 3.5% contraction to the global economy, it looks like things are now on the mend. The World Bank expects global economic growth to recover to 5.6% this year. According to a report from the International Monetary Fund, upward revision reflects additional fiscal support in a few large economies, the anticipated vaccine-powered recovery in the second half of 2021, and the continued adaptation of economic activity to subdued mobility. While there's positive movement towards global economic recovery, some analysts cite that the effects of the pandemic will be long-lasting, with no country escaping its impact regardless of their mitigation strategy. An article on Oxford Economics says the extreme uncertainty surrounding the virus's duration, path and magnitude poses a vicious cycle of dampening business and consumer confidence and tightening financial conditions, which could lead to further losses in investment and jobs. We have here quantitative analyst at the First National Bank of Botswana, to further unpack this outlook.
The growth outlook is still with significant downside risks applied to it. And that's due to the fact that we're still seeing the virus playing out in different ways across different markets. But I think to try and guard against the severe impact that the pandemic has the potential of having on most of these economies, we're likely to see continued fiscal support across most economies. But this won't be necessarily to the same level that we saw last year. And in terms of growth prospects this year, most of it will be positive as a result of the significantly low base that we're coming from last year. But in the medium term, we're likely to see fiscal support actually being directed away from operational expenditures that deal with the effects of the pandemic, more towards development targeted projects going forward. Other measures that can be put into place or that are already in place include monetary policy, where we expect most economies to actually maintain the accommodative monetary policy stances. So we're likely to see rates remaining lower for longer, just to try and ensure that the recovery plans that are being instituted the world over are properly entrenched in terms of growth prospects before monetary policy starts to normalize.
Well, indeed, it has been quite a very difficult economic climate. And while there's been some improvement in the forecasts of global economic growth, there are still worries that the pandemic will cause setbacks to economic resuscitation efforts. So in that regard, what inspired action do you think must be taken to cushion against or even prevent these setbacks?
Some of the key challenges that have presented themselves relate definitely to the virus and the new variants that we're seeing playing out. Now, as those affect different markets differently or at different times, we find that those markets institute different measures to try and curb its spread, which then obviously reduces the level of business activity within those markets, leading to, while detracting from the positive growth forecast that we expect. Another key factor is the uneven rollout of vaccines. So you find that developed markets have been better or have had more positive rollout of the vaccines compared to sub-Saharan Africa. Now, in terms of sub-Saharan Africa, this limits the degree of growth that we expect this year, or the pace of recovery that we should expect until these markets actually reach a certain level of herd immunity.
You know, we're seeing these forecasts, but so much uncertainty still surrounds these outlooks. What would you say have been the key challenges, for the adequate and precise empirical economic analysis of the pandemic?
Remember that economies are interconnected. So as one economy faces challenges with the new variant of the virus, you find that the measures that they implement usually have a ripple effect with other economies that it interacts with. But our expectation is that given the learnings from last year, economies have gotten better at being able to handle new waves of the virus, as well as the fact that we expect vaccines to be actually more evenly distributed from this point going forward, which will allow a resumption of normal business activity. But since last year, countries have gotten better at handling spikes in new cases. And over the remainder of this year, going forward, we do expect that vaccine rollout will be more evenly distributed, allowing for a resumption of business activity across a host of economies, and thus reducing the need for revised forecasts going forward.
With the global economic forecast sitting at 5.6% expansion for the year 2021, what does that mean for businesses here in Botswana? Well, while economic conditions have been quite challenging, there are some organizations that are still hanging on, weathering the storm. Take, for example, the First National Bank of Botswana, whom at their full-year financial results for the year ended 30 June 2021 announced a 2% decline in profit after tax. The bank also recorded a 1.6% credit loss ratio and an 18.2% return on equity. Fnbb Botswana Chief Financial Officer Luke Woodford sits with First Issues, telling us first what Fnb's experience has been like navigating through this pandemic.
Our big focus through the year has been on ensuring that we can give customers the same uninterrupted service that we had previously given. We started with also ensuring that we would be a responsible citizen and do whatever we can to limit the spread of the virus. We've enabled our staff in such a way that they are able to continue to serve our customers. We've placed a lot of emphasis on ensuring that staff are equipped to work from home or to work remotely from safer locations where there's less grouping together. In addition to that, we've seen a very strong uptake of digital solutions. So, for example, where the app was previously well used across our customer base, we've seen a very significant growth in that usage. As an example of the app, where you can do effectively most of the transactions that you can do via branch or via online, they can now be done on the app, and that's got biometric authentication. It's safe, it's easy to use, and really offers that seamless banking experience. So really, if I were to summarize it, it's been a focus of ensuring staff are safe, ensuring customers are safe, and ensuring that the bank can continue to run and continue to serve its customer base.
Let us now talk about the results themselves. Please give us a brief overview of them.
It's been a difficult trading year for ourselves and for a number of our customers. We've continued to work with our customers. We've restructured over 2 billion pula worth of assets just to ensure that the customers that we've banked have got the liquidity that they need to meet their obligations and really to try help where we could. Within the retail space, there was a big focus on restructuring the home loan portfolio to ensure that those customers were able to meet their obligations, as we know the customers were affected through the pandemic. As I go into the results, we see a reduction in our advances portfolio. So we've gone into the period maintaining our view of credit risk. We haven't tightened, we haven't loosened our credit appetite. In fact, we've maintained it, and we have seen that the market has continued to grow and extend credit, particularly across the household sector. What we've also seen is a slight reduction in our deposit portfolio, as we saw a very high increase in deposits in the prior year, and those have been redeployed through this year. Where I translate that into the income statement, we've seen a reduction in our interest income. That's on the basis of this reduced advances I mentioned, as well as the reductions in the bank rate in both April and October last year. But that's been offset by the reduction in the interest expense line, where we've had this reduction in deposits as well as those reduced bank rates. If I were to move on to the impairments, where we look at the credit loss ratio normalizing back to 1.6%, a pleasing result for us, where we've seen lower defaults than we could have expected going into this difficult period. I think as we've worked with customers to ensure that they are able to meet their loan obligations, we've seen very pleasing results coming from that. And certainly we have remained conservative within our provisioning approach as a bank. So maintaining higher coverage ratios, but certainly not seeing the need for heightened impairments to come through over and above that 1.6% credit loss ratio. The non-interest revenue remained resilient at 1% growth. We've seen our customer base increase by 5%, and on the basis of that, we've seen an increase of roughly 7% across transactional and other interest income. We've seen our merchant services business continue to thrive, with an increase in the number of point-of-sale devices out, as well as an increase in the volume of transactions going through those point-of-sale devices. Where the success around the growth in customer numbers as well as the point-of-sales was offset was through a sharp reduction in our foreign exchange revenue. Our costs have increased slightly by 2%. This on the basis of a 6% increase in our staff costs and a 2% reduction in our other costs. Now, those other costs have reduced as we've seen a structural change in our bank in the way in which we operate, with work from home, as well as reductions in things like printing, as well as travel, and some structural changes that we see coming into our cost base. All of this culminates in a 900 million pula profit before tax, which is flat with the prior year. A pleasing result for us, a very resilient result given the circumstances and the operating environment, and a slight reduction in our return on equity. Now, as we move into this period, we've navigated a full year of COVID. And what that's allowed us to do is to gain comfort around the potential risk sitting within the portfolio, and to reassess our capital base. As we entered into the COVID period, we maintained very healthy capital levels. As we've completed this period and successfully navigated the pandemic and the impact on our business, we're at a position now where we are able to redistribute surplus capital back to our shareholders. In so doing, we are declaring a special dividend, resulting in a total dividend for the year of 49 tebe per share, which allows for us to rebalance our capital portfolio and ensure optimal returns to our shareholders going forward.